us today. Really appreciate you jumping on the webinar here at K Properties and Investments. My name is Dwight K, and I am the founder and CEO of K Properties and Investments. Today, we're going to be talking about Delaware statutory trust properties and the due diligence that we do at K Properties with our teams on each one of the offerings on our marketplace. So I'm going to give a quick overview of K Properties, who we are, as well as the K Properties marketplace. We're gonna jump into that briefly, and then we're gonna dig into some of the actual diligence materials that we look at when looking at the due diligence or looking at the various Delaware statutory trusts, the 1031 exchange offerings, as well as the 721 UPREIT offerings. So I'm gonna be brief. I know this is a very important topic for everybody, but there's lots and lots of data, and so I will be brief and give you just an overview. But really quickly, K Properties, we've been helping 1031 exchange investors for nearly 2 decades. Our team members for nearly 2 decades, helping them understand what their 1031 exchange options are. As of this date, we've done roughly 10,000 different Delaware statutory trust and 1031 exchange transactions, and that's spread across nearly 4,000 investors nationwide. So we've been considered by many to be the largest advisory firm helping investors understand the DST marketplace in terms of volume, and that we've done more of these DST transactions than anybody else from the advisory standpoint. And so personally, going back to 2008 was when I bought my first DST investment. Personally, I was working with investors and wanted to participate alongside them, and I made my first DST investment. Since then, I've done numerous DST investments, dozens and dozens and dozens of them personally for my family, both 1031 exchanges as well as direct cash investments across many different DST sponsor companies. We're kind of sponsor company agnostic at K Properties. We just want to make sure, hey, have they done a good job for our clients in the past? Nobody's perfect. Anybody investing in real estate can lose money when buying buildings, just like you. Not every investment you've ever bought or made, whether it be the stock market or real estate, et cetera, has gone up in value. Investments go up and down, so there is risk. But we're looking at, the sponsor companies. What have they done in the past? What's their track record? Doing a deep dive on that track record and digging in at their performance, how they've treated our investors, as well as ourselves. I've invested with many of the different DST sponsor companies over the years. So, same for some of our team members. So we've got a lot of experience with these groups in terms of, not just representing, thousands of investors nationwide that have chosen to work with K Properties, but also investing with these groups personally. So we're really, the sponsor company wise, it's funny because you hear certain groups talking about, oh, only go with this group because they're the biggest. Well, some of the best returns that we've seen over the years have been some of the smaller operators. And obviously past performance doesn't guarantee future results, but some of the smaller DST sponsor companies that are very focused, very niche, we've seen some of the best returns for our investors. And so, at the end of the day, we want to do a broad-based, diversified portfolio, just choosing one DST sponsor or one DST property or one 721 UPREIT sponsor and putting your entire 1031 exchange proceeds into that one offering really exposes you to concentration risk, right? And that's what most of our clients are trying to get away from. They don't want to be in one property, in one market, one asset class, one state. They want to be diversified. Well, then going from that overexposure in that one property into another single property or single REIT, you're just going from one overexposed situation to another. So diversification is really, really important. But so K Properties, again, we've been doing this for a very long time. We're considered by many to be the largest group that does the advisory side in terms of number of clients that have chosen K Properties and chosen us to work with them over the years. Many of the people selling DSTs are financial advisors, financial planners, RIAs, wealth managers. Not bad people by any means, but they do 1 or 2 1031 DST per year. And as a result, their clients just don't get that experience that we have for our clients, and the experience with the sponsors and how they've performed and what their reporting's like and what asset classes or property types that the sponsor's good at, which ones that they're not good at. And so, you know, it's kind of like when you go to a specialist for a surgery, say a knee surgery. You want the knee surgeon, the orthopedic surgeon that has done 10,000 different knee surgeries. You don't want to go to the guy that just started or maybe started doing them a couple of years ago. And that's kind of why clients from all over the country end up choosing K Properties, because this is all we do is 1031 and DST properties and real estate investments. And we've been doing this for a very long time. And so, you know, our clients are coming to us for expertise, for specialization, and for a group that really lives and breathes this every day. The other type of DST, people that sell DSTs often are, you know, people that are trying to emulate what we've done at K Properties. We've been incredibly successful. All thanks and glory to God for the blessing that He's brought us over the years. But a number of groups saw what we were doing and wanted to replicate it. And they're not bad people either, but they just haven't been doing it as long as us. So they might have a website that looks exactly like ours. They're saying they're the specialist, Well, they might have started 3 or 4 years ago. That's fine, but again, they just don't have that experience or the volume. So, but this is real quick before we jump into the due diligence. This right here is our K Properties marketplace. This is at kpi1031.com. Okay. When you go to kpi1031.com, you're going to have access to our marketplace. You'll see testimonials, you'll see about us, press. We're regularly featured in the news. Kiplinger, Forbes, other publications will publish stories on us, learn about our team. You'll also be able to see our blog, the DST blog that we have. It's really fantastic. If you're looking for education on 1031 DSTs, things to look for, you're going to see a lot of it here. You're going to get a ton of information. This goes back years and years and years, so you'll get to hear and learn a lot about us. The marketplace is really interesting in that K Properties is different than a lot of groups. A lot of groups will say, we did the due diligence and we like this 1 or 2 deal the best. They're the safest ones. Well, first of all, no real estate is safe. There's risk in all real estate investments. You can lose your money. There's no guarantees for cash flow, no guarantees for protecting your principal. But what we do at K Properties is we're really digging into the different sponsors, and so we're not choosing 1 or 2 offerings, which is what a lot of the big financial advisors and RIAs do and say everything else is horrible. These 2 are the only good ones. We're actually looking at the entire marketplace, all the different offerings from all the different DST sponsors. We're reviewing them. Some of them don't even make it on our platform. Some of them do, but we've labeled them risk awareness, where there's extra layers of risk, and then others are generally, make sense for a lot of our investors, and so they don't have a risk awareness component, but they do still have risk. You could lose money, right? But that's kind of how K Properties is different, is that we are not just showing you one sponsor's deal, not just showing you, a couple different deals. Everybody's different. Everybody has different unique needs, goals, and objectives. And so our marketplace basically, brings together over 25 different DST sponsor companies, as well as REIT sponsor companies. Over 25 of those groups, we go through their offerings, we do the due diligence on the properties, which I'm going to show you shortly. And then the ones that do pass, we'll put them on the marketplace. We'll still walk you through the pros and cons of each one of those. They all have their risk factors. We're going to provide you the private placement memorandum. That's going to go through the business plan as well as the risk factors of that specific investment. And then from there, we're going to help walk you through what makes sense based on your goals, objectives, and criteria, as well as, from our past experience doing this for nearly 2 decades, right? So that's kind of the beauty of the K Properties marketplace, is that we're showing you, multiple offerings from multiple sponsors, not just 1 or 2 different deals, okay? So K Properties also uniquely, because our volume got to a point where we needed more offerings for our investors, back in 2015, 2016, there were hardly any debt-free DSTs in the market. Okay, all the DST sponsors were putting debt on their properties. Maybe once or so a year, twice a year, there'd be a debt-free DST. But a lot of our clients needed debt-free DSTs. They didn't want the risk of a commercial mortgage or a multifamily mortgage. There is a level of risk with taking on debt. And so a lot of our clients needed debt-free. We went to the sponsors, said, hey, create some debt-free DSTs. And they laughed at us because even though we were the top producer raising all the equity or a lot of the equity in the space, they laughed because they're the institutional groups that you got to use debt. Why wouldn't you use debt? Debt's important, Yes, debt's nice. You can increase potential returns. You can increase potential cash flow if interest rates are lower than your cap rate. However, it creates a lot of risk. And so we kept on knocking on doors to different sponsors, and we were able to convince one of the largest sponsors in the DST space, hey, let's do a joint venture. And you guys run the real estate, K Properties will raise the capital. We're the biggest capital raising group in this space by far, by a long shot. And they agreed to that. And we were able to do that with a handful of different sponsors, some of the largest ones in the space. And we did about $700 million of debt-free DST properties from 2015 till now. We did those as joint ventures. They did, very well for our investors, keeping them protected from the risks of debt. Fast forward, a lot of debt or leveraged DSTs, they're having to be sold right now in 2025 because it was 2015. They put a 10-year loan on it, and they're selling at an inopportune time with rates being high, the economy being a little uncertain. If you don't have to sell, it'd be better to hold on for 2, 3, 4 years, right? All the debt-free deals are able to do that, where the ones that were leveraged, some of them are being sold at right now at losses, at marginal gains. So, being debt-free really provides you flexibility. So the neat thing about that strategy of doing the joint ventures, doing the debt-free DSTs, and providing them as an extra option for our clients is that if you look forward to today, 10 years later, depending on any given month, probably 50 to 60% of the DSTs in the wider marketplace are debt-free. So it's been wildly successful. Investors are wanting debt-free offerings, and we've had a hand in changing the market. Excuse me, had a hand in changing the market. So very happy with that. We also have a sister company at K Properties called Cove Capital Investments. We launched Cove Capital in 2018, wanting to provide more debt-free options for our investors. Cove Capital, the first deal we bought was a FedEx distribution facility in Winston-Salem, North Carolina. Since then, we've sold it, made a nice gain for our investors on that property. And also since then, we've bought over 115 buildings, which is about 3 million square feet, maybe more, I think. Over 2,000 investors have selected Cove Capital to place 1031 DST investment money into Cove Capital offerings. And we've really built out a fully integrated real estate company at Cove Capital. So that's a sister company of K Properties. Again, K Properties is unique in that we don't just show you the Cove Capital deals, right? We'll show you over 25 different sponsor companies' offerings. So you get to see and compare and contrast. It's the same as if you wanted to go buy a 5-unit apartment building in your town or city. You wouldn't want your real estate agent to go, here's the 2 best ones. You'd want to look at 15, 20, 25 different listings, compare and contrast, look for the ones that there's potential value that makes sense for you. And then from there, start offering, right? Same thing here. We're showing you options, not just 1 or 2 sponsors. And that's something very unique about K Properties. But so this is basically the platform, the marketplace. You get testimonials, education, tons of various video opportunities. But if you wanted to log in and see the live offerings, you just click login, you put in your email, and then from there, your password. If you don't have a password yet, feel free, reach out to our team and we will get you set up with a password. So starting next year, I want to show you some of the diligence that we do here at K Properties. Again, we work with all the different sponsor companies, right? Some of the deals are rejected. We don't put them on our platform at all. You won't even see them because I want to invest in them personally. It's not something that I'm going to have our clients invest into. Okay. But all these here are different sponsor companies that put out DST properties from time to time, some of them much more active than others. Inland, Pasco, Hamilton Point, Griffin Capital, Go Stored, Four Springs, Exchange Right, again, Cove Capital. All these groups have offerings that they're putting out that we're walking through the diligence, digging into, okay? And when we get an offering, this is a brand new offering we just got. It's from Starboard. The founder of Starboard used to be Pasco's, one of their top real estate professionals, left Pasco, I don't know, 3 or 4 or 5 years ago, started Starboard Capital. We've had a lot of investors with them. They'll launch a deal. We'll get the private placement memorandum, and this is in Columbus, Ohio. It's the Mackley Place Apartments. But essentially, we're going to get that offering, and then from there, we're going to dig into the diligence, okay? And what does that look like? Well, the sponsor is going to give us a number of due diligence items, okay? I'm going to start with the appraisal. We're going to get the actual appraisal when the sponsor went to contract on the property. This one's done by Colliers, and really digs into, what's going on at the property level, comps, sales comps, submarket comps, etc. Okay, so we're going to look at that. Excuse me. Then we're gonna get the environmental report. We're gonna get the phase 1. The phase 1 is gonna it's not gonna open it. Gosh, sorry folks. The phase 1 is basically the environmental report, digging into, is there any environmental issues we should be concerned about, the recognized environmental concerns, or is it a clean phase 1? If there's not a clean phase 1, then we're gonna get a phase 2, and we're gonna have to understand that and just kind of digging in what's going on. We're getting a copy of the survey. We're getting a copy of the zoning report, okay? Is it conforming? Is it non-conforming? What's going on? And basically, we are taking all this information. We're getting the insurance documents, the certificate of insurance, we're getting title commitments, etc. We're getting this for every offering, right? We have typically, at any given time, we have 30 to 50 different offerings on our marketplace. So K Properties, we have teams of analysts that their job is to go through these properties, not just the private placement memorandum, but all the actual due diligence materials that the sponsors commission as they're about to buy a property. This is the Freddie Mac multifamily loan, right? Looking at the loan docs, because loan docs are important to look at. A lot of loans in today's environment and DSTs, some people won't tell you, but they have cash traps. Essentially, if something goes wrong at the property level, you can trigger a full cash flow sweep for the lender, where the lender no longer allows you to have rents go to you. It goes to a lockbox, and until you get out of that, they're just holding those rents as extra collateral, and it means no cash flow to investors. A lot of sponsors, not just in the DST space, but REITs and large institutions, have triggered cash trap provisions per their loan documents. So it's something that we like to understand and be able to walk our investors through. We get the property condition report. This is going to tell us what's going on at the property level, what immediate repairs, what long-term repairs are needed, and then we can compare that to the reserves that the sponsor has set aside. Do they have adequate reserves to handle the various items that need to be fixed or repaired or maintained over the years, okay? Next here, we get a copy of the contract, the purchase and sale agreement, the settlement statement, and then tax abatement if they have one, which this property does. So that's the sponsor's due diligence. We're digging into that, looking at it, is this reasonable? And then from there, we're going to compile our own reports, okay? So essentially, we're looking at, at K Properties, we commission third-party market reports, different groups such as CoStar or Placer AI, where we're digging in and we're looking at, what's going on at the property level. This is very expensive to have these reports done, and it's essentially giving you information as to, what kind of development is going on, what kind of absorption, are the properties leasing up, what are the comps, what if stuff sold at in the market, what is stuff rented at in the market, where is the sponsor at in terms of it. So basically having access to these reports provides a level of information that our team is able to look at that many just don't have, because you know what, they don't specialize in this. We have the resources to do this because we specialize in this. This is all we do. And so from there, we're going to put all that into our report, where we're digging in, going through the appraisal, the property condition report, the environmental report, all the zoning. We're compiling it into our report, digging into the costs, the fees, the reserves, what has the sponsor done in terms of putting the offering together, looking at, the loan, what kind of issues are there with the loans? Is it interest only? Is it amortizing? Are there prepayment penalties? Does it have bridge financing? What are the default triggers? Looking at the sponsor's assumptions, how fast are they growing their rents? How are they, are they growing expenses? What do they have projected for vacancy, et cetera? And we're able to compare that to those third-party market reports that we look at, such as the CoStar reports, digging into the sales comps, the rent comps, really trying to understand the offering. This is what you do when you buy a property. You order all these reports, and we do that at Cove. We've done it, a huge number of transactions, more than probably a lot of people that specialize in, sponsors. A lot of people working at sponsor companies have been there for a couple of years, and they're, the workhorse is doing the work. So the amount of deals that we've done personally truly is staggering, and we're incredibly blessed to have done that much business and helped that many investors. But this is the stuff that we look at when we're buying our own properties. And then at the K Properties Marketplace, when a sponsor buys the property, submits it to us for us to put some clients into it that might have a 1031 need, we're digging into the same stuff, okay? From there, we're essentially going to take all this data, okay, from all the comps, all the reports, etc., and we're going to put it into, we're going to put it into our report, okay? So our due diligence report really digs in to all these different things and puts it all together in an easily digestible way for you and for our team to walk through and see what's going on at this property, right? It's important to note, due diligence does not guarantee profits or protect against losses, but it's something you want to do when you're making an investment or buying a property. All offerings, that we're showing, we do the due diligence on, we look into it, but again, there's no guarantees that there's going to be a successful investment, no guarantees, but that's why it's so important that we look at it. So we've got our K analyst notes. The subject property's acquisition price was 4.5% lower than the appraised value, which is a good thing. Looking at the comps, etc. Priority repairs, 11,650 per the property condition report. So brand new property, looks great, no really needed issues at all. And then from there, what kind of reserves? 821,000 is the 12-year adjusted projected replacement reserve. Over a 12-year term, there's going to need to be $821,000 put into this property. And so that's very important, because with the DST, you're not able to add new capital to the DST. It's per the IRS ruling, one of the 7 deadly sins. And you want to make sure, does the sponsor have enough reserves over the whole, or capitalize up front to take care of those repairs, right? So again, we're looking at the comps per unit. We're looking at what's traded in the market. We're looking at the rents that they're getting. Are they above market, below market? If so, why? On all the different comparable properties for both 1 bedrooms, 2 bedrooms, etc. This isn't a retail property, but if it is a retail property, whether it be single tenant net lease or multi-tenant retail center, shopping center, we subscribe to Placer AI, which essentially pings the cell phones of the visitors, and it can tell us how many people went to that property over the last 12 months. And then we can compare it to comparable properties and find out, is this one of the dominant locations for those retailers or that retailer, or one of the least trafficked. And that helps our buying process when we're buying properties on the Cove Capital side, as well as when we're looking at properties on the case side. So Placer AI is pinging cell phones. We're getting that data, and we're able to look at, leases. Has the tenant renewed theirs? Is there a strong commitment to the location? From there, okay, they've renewed. We can look at their store sales. Is it a healthy store sales ratio? Are they making money as a business at this location? And then on top of that, the visitor traffic. So that really helps us get granular on these offerings, because again, due diligence doesn't guarantee that the property is going to perform and you're going to make money by any means. You could lose money in any real estate or DST investment, but it's something you really do need to look at. And this is the type of information that we're doing because we specialize in this. We also have a number of RIAs over the years that have personally 1031 exchanged with us, financial planners, RIAs. They've done their personal exchanges with us, even though they have the right licensing to sell these things themselves. They come to us because they want access to our due diligence. So not only have we helped their families with their own personal exchanges, they also have their clients invest with us. Even though they could sell it themselves and make more money, they recognize this is a highly specialized process, and we've been doing it for a very, very long time. So we have an investment summary, the pricing, appraised value, sponsor acquisition price, sponsor cap rate, appraised value cap rate, looking at the gross rent multipliers, looking at the load and the costs on the investment. Basically digging into fees and expenses. What is the sponsor charging? Asset management, property management, disposition fee, master lease, looking at their assumptions for rental growth rates and vacancy rate and concessions. And then again, looking at the environmental report. No RECs, recognized environmental conditions, were identified during the course of this assessment. That's really what you want to see. There's no environmental issues. That's really important. So basically compiling all that information, the lender information, who was the lender, what kind of loan, how long is the loan, what's the loan to value, what's the interest rate, what are the default triggers, what are the prepayment penalties, it's just kind of what's going on at the property. And then we do a summary of the actual market. Okay, so the Columbus market here, you're getting extra information on top of that private placement memorandum, which the PPM does have a lot of good information, and we encourage investors to read it, that business plan, the risk factors, what the sponsor's hoping to do with the property. But this is just a whole nother layer above and beyond that many don't even do. One of the things we've heard is that some people will say about Cove Capital, oh, they only approve their deals, they don't do good due diligence. And it's kind of a hilarious thing, because really, Cove Capital, when we buy a property, when my partner and I, Shay Lapin, who owns Cove Capital with myself, when we launched it years ago, when we buy a property, we're the owners of that property. The markets could shut down, the economy could fall apart, and our families own that property because there's no more 1031 equity, right? We saw that with coronavirus. The market shut down for 4 or 5 months. With rates rising, that could easily happen. And so we got to be very, very comfortable in any property we do at Cove Capital. And that's why we order, and it's very expensive to do this, every property we buy at Cove Capital, we're ordering the property condition report, the appraisal, the environmental, the zoning report, all that diligence going into that property. And mind you, we've made 100 offers. We've been awarded 5 or 6 deals. Of the 5 or 6 deals, 2 or 3 go to actual contract, purchase and sale agreement. And of those 2 to 3, we're ordering all that stuff and diligencing that property, and then we're closing on it, right? And so when we close on a property, we have all the confidence in the world that this makes sense for our investors, or else we wouldn't buy it. So for somebody to say, oh, they always approve their own Cove deals. Well, yeah, we do, because we're looking at tons of deals. We have our acquisitions team, our asset management team, our general counsel, our paralegal, our CFO, the entire team at Cove Capital is digging in, diligencing the Cove deals. And then from there, once we buy something, yes, it will be approved because we've already done all that work and it goes on the Cove or the K Properties platform. That being said, we also go through that information for all the other sponsors that are on the K Properties platform. Those are the ones where if something comes across our desk and we go, wow, I don't like this environmental concern here in this phase 1, they have a phase 2, it's got some funky things. I don't like that, our team doesn't feel comfortable with it. No, we're not approving that, right? If it was on the Cove side, if we got that and we weren't comfortable, we would have canceled the contract and it would have never made it to the K side, right? So you just have to understand these things from all the different equations. Yes, people will say negative stuff about K Properties, but the fact of the matter is we're doing more business, we've helped more people, we have more clients than anybody in this space. And just like when the Patriots were winning the Super Bowl, people that didn't live in New England didn't like them. They were mad, right? And they said all sorts of stuff about them. The stuff's not true. We do an incredible job for our investors. Just read our testimonials, read our reviews, talk to our clients. We've got clients that are still investing with us today that worked with us almost 20 years ago. We've done a very good job for our investors. So at K Properties, we're going to show you all the different offerings, different sponsors. We're going to diligence them. We're going to walk you through the pros and cons, and you're going to get to see it yourself. So that's a little bit there about our process, looking at the sponsors' diligence, then from there, digging in, compiling all that information into our own diligence reports. And again, if an offering is approved, well, from there, we'll submit all of that to our broker-dealer. Our broker-dealer will do their compliance review, their due diligence, and from there, if it's approved, we'll put it on the marketplace, but we will walk you through those pros and cons and the risks of any one of these investments, okay? From there, I wanna give you guys a quick overview. We also, because of the 721 exchange and what it means in terms of an exit strategy, a lot of the offerings out there now have a 721 exchange component. We have a REIT coverage team, and what that does is any one of the 721 UPREIT DSTs that are available, you can't just look at that DST and that property and that sponsor and go, ooh, I like this. You have to look at the final destination REIT, okay? Where is my property gonna go and what am I gonna be invested in once that 721 happens in a year or two? And so we have a team of analysts that really dig into each one of the groups out there. That essentially each one of these is doing, they file public material. It's their Ks and Qs, their quarterly and annual reports, where they're talking about, hey, here's our REIT. They file it with the SEC. Here's our REIT. Here's occupancy at the REIT. Here's what we hold. We look at the adjusted funds from operations. We look at their dividend. We look to see, is the dividend being supported from actual real estate operations, or is it coming from new borrowings? A lot of these 721 groups pay their dividend out of new borrowings, which we just don't think is sustainable. We look at the debt. We look at, is this debt long-term fixed rate debt, or is it short-term debt, right, with variable interest rates? A lot of these 721 UPREIT programs, they got greedy back in 21 and 22 and pulled out all this adjustable rate mortgage debt on their REITs because it was cheap. It was, 2% debt instead of, 3.5 or 4. And all of a sudden that 2% debt is now 5, 6, or 7 debt, and it's really dragging down the REIT as a whole. So we really want to look at each one of those. We're looking at the debt, looking at the coverage ratio. We're looking at, we have all the sources, all the SEC filings. And we're doing that for each one of the actual groups out there that's putting that in there, okay? So we're looking at the REITs, and any one of these could do really, really well, okay? But if we look at a REIT right now and it looks upside down, we don't want to take that risk with our clients. And even though it has a big name, they've got a big track record, a big name, we really want to scrutinize it and make sure our clients understand, hey, this is what you're getting into. You're debt free now. You're now going into a REIT that has, a whole bunch of adjustable rate mortgages on them that could be a potential problem. Not saying it will, could be, do really, really well, or it could have problems. And so we're digging into that as well. And that's a level of diligence that most just don't do. So that's the wrap up of the webinar. Thanks so much, everybody, for joining us. I just appreciate each one of you taking your time. Our team at K Properties, we'd love to walk you through this in more detail. Again, we've been chosen by more investors nationwide to help advise them on which DST sponsors to invest in than anybody else in the nation. So we're very blessed to have that statistic. And so we're here to help you. We're here in Los Angeles. We'd love to have you come out, fly out, visit us, visit our teams, understand more what we do, why we have been selected by more real estate investors, real estate families, even institutions that have placed capital on the K Properties marketplace than anyone else. So thank you. Have a wonderful rest of your day, and just appreciate each one of your time here.